the analogy that I always give everyone is that a collection that someone would have on there, if it's 3 years old, 5 years old, it's the equivalent to this finger right here, me going to the doctor, having it rebroken, reset so it looks nice and pretty. It's going to look prettier in the long run, but I'm going to feel pain and I'm going to have problems typing and doing everything I need to do in the very short run. Is that analogy a good analogy with the concept of paying off bad debt?
Welcome to Stop Whining About Real Estate. Join us as we chat, sip, banter, and wine with the best in the biz. Grab a glass of your favorite vino, sit back, relax, and let's whine together. On today's episode of Stop Whining About Real Estate, we're welcoming a powerhouse guest who's just as passionate about credit as he is about making connections. He's the engine behind Liberty Credit Experts and the force growing one of Florida's most active networking communities. If you're ready to learn, laugh, and maybe even rethink what you thought about you knew about credit, let's go. Please welcome Gabe Kutlin.
Well, we've got an awesome show. Welcome, everybody. My name is Emmanuel St. Germain. I am the host of Stop Whining About Real Estate and Simple Sarah's. I've got my co-host with me today, Sarah Birnbaum.
Thank you.
She's the business director, business development, liaison, manager, director. She gets upset if I don't use her right title of our company, Choice Mortgage Group. But more importantly, our guest today is a good buddy of mine, Gabe Kutlin, who owns... What's the name of your company again?
Liberty Credit Experts.
Perfect. Thank you. Liberty Credit Experts. So we are going to try to keep this as basic and as simple as possible. Credit, obviously, for me, I've been in the mortgage industry for 20 years, is a really important thing, and I've had to learn a lot about it, but I obviously am not the pro that you are, Gabe. So I want to just kind of start off with, from a real estate, let's start super simple. Let's identify when someone, what are some of the free resources that we were just talking before we started the show? What are some of the free resources that an individual would look at? And where would they go to do that if they're interested in seeing what kind of score they have? And then also, you know, we can talk a little bit after about what are some of the different models and things like that. So we're going to try and keep it super simple.
Sure.
Third grade Chat GPT level, like Sarah reads.
No worries. Okay. So, I mean, if you want to talk free, a majority of the time, these companies are going to charge for a score, specifically for like a mortgage credit score, like a FICO 2, 4, and 5, right? They're gonna charge for that. But a free resource where you could check your credit report on a weekly basis to see whether the information is correct or not would be annualcreditreport.com, right? That's free. That gives you a different credit report for every single bureau, TransUnion, Equifax, and Experian. And it allows you to just go in there and see exactly what's going on. Now, they can prompt you to pay for a score if you want to. I mean, that is like what their business model is, right? But at least they can see it for free. Other apps that are out there, like Credit Karma, obviously are free, but you know, we run into some confusion as to what is the correct score that a loan officer would be using to assess risk if someone's trying to buy a house.
So that's a great. Let's go there. Sarah calls me up, thinks she has a 780 credit score because that's what Credit Karma says. Now, we in the mortgage world, we use what's called a tri-merge credit report. So we pull all three bureaus, and all of a sudden, her middle score, which is the score that we use. So we don't care about the high score. We don't care about the low score. We're using the middle. And now Sarah's 780 was actually a 680 as an example. Why is that?
Well, the reason that happens is because it's a different type of risk model, right? So Credit Karma uses Vantage Score 3.0, which is actually a model that was created by the bureaus. It's their own type of, you know, score generating risk assessment algorithm that they have, right? Just like FICO has their own. And the problem with that is that although it's measuring risk, it's not calibrated in the same way that a mortgage score would typically be calibrated, right? So it's completely different. So when you do have that one client that is like so proud of their 780 Credit Karma score, and then they get so let down by the score that their loan officer shows them, you kind of have to direct them or instruct them or educate them in a way for them to understand exactly what's going on. Just because it says it on your phone doesn't mean that it's the truth, right?
Still have to pay your bills on time.
Right, yeah.
So quick question really quick. Let me just interject really quick. So I understand Credit Karma and they have a different algorithm. But if you were to
Different
pull
models.
Different model.
Total models.
Okay, total model.
Buying a
And they're
car is a
pulling-
different model.
Perfect.
Yes.
So let's say you wanted to be prepared to speak to a loan officer and you went to Equifax and they pull all three of the bureaus.
Equifax is one bureau.
But you can go on the website
TransUnion,
and they can pull
and then
TransUnion
Experian.
and Experian on there.
Okay.
So if they pull all three, could you have a better idea of where you're going to score when your loan officer pulls it?
My suggestion, if you want a more accurate assessment, is go to myfico.com.
Okay.
Which will actually give you all of your FICOs. So your client might come to you and say, well, my phone says that my FICO score is this. But what kind of FICO is it? Because now, if you want to get even more complicated, put Vantage on the side, right? Put Credit Karma on the side. FICO has different scoring models and different ranges for different products as well. So now you might have a client that says, well, my app says that my score is this, but in reality, it's really a bank card score, which is for buying a credit card, for getting a credit card, the risk of a credit card, not a mortgage score. And the range is completely different. It's from 250 to 900 versus the range for a mortgage, which is 300 to 850.
Okay.
It's completely different. So it gets very complicated. So my FICO will actually give you your score, your mortgage score, or a very close score to like what you would be pulling. Obviously, credit changes like every second all the time.
Got it. Of course. Okay.
Yeah.
Okay.
So we got the MyFICO. All right. So credit, obviously, so that's a big piece of it. And I think it's a valid point for someone trying to prepare to be ready so that they have an understanding of what they're getting into. Now, keep in mind, when I started in this industry, the rule 20 years ago, the rules were very, very different, right? So today, when we pull your credit, like it mails you a copy of your credit report. Like there's so many different compliance pieces to it where it's not like I'm going to say, oh, Sarah, you have a 600 credit score. Meanwhile, you have a 780 and I'm selling you terms on a 600 credit score, but you had a 780 the entire time.
Right.
In the disclosure package, we have multiple documents that show exactly what all your bureaus are. Now, here's another one that I get all the time, Gabe, and you can laugh with me at this. Client will have an 800 credit score.
Mortgage jokes.
What's that?
Mortgage jokes.
Mortgage jokes, yes. So the 800 middle qualifying score, and it will say too many inquiries, like, because even though you have a perfect score, so in my world, in the mortgage world, once you have over a 780, nothing's different. So an 849 or 781, it's the exact same thing. 780 is the highest that we need.
It's like tier one.
On my side, tier one, if that's what you call it. But it still tells you that you have too many inquiries, too many,
open accounts, too many balances on revolving credit and things of that nature.
And a guy or a girl with perfect credit, they're like, what the hell is this? And they complain about it. And I always laugh because I'm like, listen, I get it. You're reading it, but like, you got excellent credit. Don't worry about it.
Calm down.
Calm down. Right. Why is that information on there if they have excellent credit? Any idea?
I mean, it depends what you consider excellent credit. I mean, the scores are there to assess risk. So if there's some indication of risk, right, then that's why it's notated in that area. So scores aren't there to show you how awesome you are. Scores are there to show you how potentially unawesome you can be by not paying your bills on time, right? So people who have an 800 plus score have less than 1% chance of going delinquent on their responsibilities or going 90 days past due. And the lower your score goes, the higher the risk ultimately will be. So a lot of times that's just could be like automated data based on some variables that the algorithm picks up on these credit reports, and it just spits out that data. But it could also be just a form of them like saying, hey, this person does have a good score, but these could be some potential risk factors that they have.
You just gave me two things there. Delinquency, I want to talk about. Next thing is going to be when do the creditors report?
Sure.
So, all right, delinquency, simple Sarah forgets to pay her credit card bill. She shopping at Victoria's Secret and overspent on her credit card and forgot to pay the bill. It now becomes, her bill is due on the 15th. It's now the 28th of the month, right? Is that considered late or is it not considered late?
If your due date is on the 15th and you missed your due date, in order for you to have a late mark on your credit report, you have to be a full 30 days late from the actual due date.
Exactly. So by the way, I know the answer to these. This is teeing them up, having fun.
Yeah.
But the point is, typically, just like a mortgage, if you're past your due date, so like for us, there'll be a late fee, but it's not late on your credit until your whole 30 days comes by.
So on 31 days.
The 31st day, it will be late, but it's all up to the bureaus. So now the reporting piece is, so like, because sometimes people will do this, right? So like my personal spending behavior is I pay all of my credit cards. I have two. I have one when I spend business money and I have one when I spend personal money, and I pay them in full every single month. Everything else is on an auto type thing. But it all is relative to when you make your payments versus because the balance that you have on a debt versus what that limit is, the proportion of that debt to the limit is very important in developing a score. So, or you can tell us exactly how important. It's like there's a level factor. This is nerding out in a second.
Utilization ratio. So
Yes.
30
No, I think I actually understand this part.
Okay.
She's not so simple today. I love
All
it.
right. Okay. Full of surprises today. So like there's 5 factors that impact your score, right? The second most important factor is your indebtedness, which is utilization, which is 30% of your score. So how much of your balances will you allow to actually report on your credit profile? Right? The higher balances, the more of a negative impact it'll have on your score, specifically on revolving lines of credit, which are your credit cards, like secure credit cards, unsecured credit cards, retail credit cards, right? So if you have large balances reporting on your credit profile, that's going to typically bring your score down. Optimal utilization ratio, the best ratio, is between 1% and 3% actually reporting on your credit profile. So although we do advise, in general, many people are accustomed to paying things off completely at zero, which is fine. It's safe. It's not necessarily the best way to actually construct and build credit, especially for someone who is like a first-time home buyer who, in our experience, can't really get over that 700 mark because they have very young credit. We always advise them to allow 1% to 3% of the limits to report on the credit profile, so it shows usage, which will actually stimulate the algorithm and factor more things in a positive way, and it'll allow them to build. Now, they say, well, what about the interest? And I'm like, well, you don't pay interest on zero if you do what I tell you to do, right? And typically what you want to do is you want to make multiple payments. You want to make sure that 1% to 3% reports to the bureaus, and then make an additional payment afterwards, eliminating the balance so you don't pay any interest at all. So now, like, how do you figure that out? And it goes back to your other question that you were talking about, the statement closing date and the due date. When do they actually report the information? So there's the bureaus, right? There's TransUnion, Equifax, and Experian. They're credit reporting agencies, and there's tons out there. You know, there's bureaus out there that have reports on your medical information, on the prescriptions you've taken, on your social media activity, everything. It's crazy, right? Yeah.
Psych word, Sarah.
Yeah, exactly. Yeah,
That was not sticking.
Yeah, there was an alert there. But yeah, so basically the data furnishers, these are your banks, your collection agencies, your finance companies, are the ones who have the power to send the information to the bureaus, right? And typically they send the information after the window closes. We call it the window of opportunity, which is the statement closing date, which is completely different from your due date, right? Yep. Sometimes the window of opportunity is before the due date. Sometimes it's after the due date. You just have to either call your bank or check your statement, right?
Will they tell you?
Yes.
They will tell you, yeah.
So it does. So if
it tells you.
Go ahead. Where?
It does tell you. It'll tell you on your statement, or it'll tell you if you go log on. It'll tell you your closing date, and it'll tell you your payment due date.
Right.
Got it.
Or you just call them and be like, hey, when do you typically report to the bureaus? And every bank's going to be different. And typically every customer could potentially be different as well. It just depends on like where their account is with that specific entity.
I have 3 cards and all of them are different and I have them all marked so I can do my double payments and make sure that things are being reported, but I'm also paying and I'm not paying the interest.
Financial Sarah.
Simple.
Love it. Good for you. That's awesome.
Yeah.
Thank you.
Smart.
So figure out when your statement closing date is.
Yep.
That's when they're going to send their information to the bureaus, you know? So if you have a client who's actively paying down their debt, if they know when the statement closing date is, it could be after the due date. It means that they have additional days to send more money into the bank, which is great because banks love liquidity.
So
right?
closing date is the date that we're really looking for. If we're going to help, so if I'm helping Sarah raise her credit score, Sarah would send me her statements of the debt that we're looking for, or would send me a picture, whatever it is, so I can see the due date and the closing date. So already I've learned something. I didn't know there was. I didn't know that date was
And a lot of
published.
consumers are like, oh, well, aren't I still going to pay interest on whatever balance is left? Technically, you could, but a majority of the banks have a 21-day grace period where no interest actually accumulates on any debt that is carried over on revolving credit.
But we're trying to raise scores here. I think the people in my mind in this example that I'm using aren't the kind of people that are
Worried about a couple of days.
worried
of
about a
interest.
few days. They have debt.
It's like
It's just trying to figure out how do I minimize the debt.
Paying
Let's
it
talk
down.
right.
Yeah.
Let's talk about rescoring because that is also something that is a big misconception that I get a lot of clients that think it's going to take months to rescore a credit. Now,
can I add one more thing to that? Because this is something that I hear from agents all the time. I get asked all the time, do you have somebody that you know that can give us a score boost? And I think that that's very different than rescoring. And then that's also different than paying down debt and waiting a couple months for everything to kind of even out and raise your score.
Is that a shot, like a booster shot?
So the boost is not a real thing. It'll show you on like a Credit Karma or something like that, but it's not going to show on the report that you pull. It'll be
What is a boost?
Isn't that drink that like older people drink?
Experian Boost.
I'm just kidding.
Have you heard of the Experian
Yeah,
Boost?
I've
Of
heard
course
of
you have.
Experian
Okay.
Boost, yeah.
So can we talk about the difference between a boost, a rescore, and then actually what you do? Repair.
Okay. Yeah. So rapid rescoring is something that you
What I
guys would
do.
typically do.
Right.
Rescore for me is we have to prove to the bureaus that you had your Macy's card here, had this balance, and now today it's this balance. And the reason we're doing a rescore is it typically takes 3 to 5 business days. For the bureau to update, we pay a premium for that. It's like $30 a trade line per card. So like your Macy's, if we're getting all 3 rescored, it's $90 for one score because you brought the balance from 500 to 100. But if the limit was 500, that may make your credit. You can see on all of our credit reports, it shows all 3 of your credit bureaus, and then it has short-term improvements. It tells us right away what you can do. And so if someone has 640, 650, 660, and there's nothing different over here, then it's telling me that they're really, other than disputing an account, getting a collection deleted, something that is extra effort and not easy to accomplish because most collection agencies or most debtors don't want to delete something. You have to rescore it. So the rescore for us is definitely doable, but it's expensive. But we can do it in 3 to 5 days, not have to wait the normal 30 days. I don't know what a boost is.
I mean, a boost, Experian Boost is basically they take your utility bills that you pay, they gain access to your like checking account data, and then they see whether you're paying things on time or not. And it's a way to add additional trade lines to that specific bureau in order to have some sort of boost.
Got it. So when I see that, like when I see certain utility bills on people's credit, that's what they did. They did a boost.
More than likely, and it would specifically be.
Manuel's learning so much today.
And it would.
Yeah, I've learned 2 things already.
And it would emphasize the Experian score because those trade lines typically are shown on Experian.
And we don't count those debts against the monthly payment either. We mark them off as omitted.
Oh, those specific trade lines
Yes.
that report? Okay, yeah.
The utility ones, and like I've seen a phone one, I've seen a utility. I'm trying to think of like, but I've never heard of Boost, but that's all.
Yeah, and then there's like other
around
misconceptions. I don't know if they're really misconceptions, but they have like other products out there that will report your rent, right? But they'll report your rent to like a FICO 8, which typically isn't going to be used for mortgage lending. So sometimes consumers want to get that good score, but they don't really know the whole story. And they end up buying something that isn't generally going to help them out.
Right.
You know?
So FHA did make some changes to that. So now we can add verification of rent as a positive history. It doesn't affect from a score, but it's so one thing people don't realize about the mortgage industry is that we don't just collect this data and do everything with it. There's actual computer systems, and one is Fannie Mae's and one is Freddie Mac's, and they read the information. So the data has to work, has to match. And by putting in this positive rental history, which isn't on a credit report, it's like a check, something you check off type thing. It's adding to the value of the approval.
Yeah, and I think I recently saw that they're now going to be looking into Vantage or allowing Vantage 4.0 to be used now.
Well, they're trying to open up the pool. So this is just like back in 2010, I'm going to say, and when we came out with the first-time home buyer credit, which was an $8,000 tax credit that the Obama administration had put in, the whole concept of that is we had so much inventory, we needed to find ways to find buyers, and now we have a similar problem. They're trying not to create too many new products, but opening up credit possibilities.
Yeah, with an emphasis on trended data over 2 years and more of a look on debt and whether they're managing debt or not, and opting certain things out that are affecting consumers on older models of FICO, which medical? Are currently being using right now. Yeah.
So
medical is medical is transitioning out. I mean, I don't.
It already is transitioning.
It shouldn't even be like you shouldn't. If you do see one, let me know because we'll dispute it. You know, that's an example of what we could potentially do, right? So that was rapid rescore. Boost could be like, hey, I just need an extra boost of some kind. Sometimes there's different products out there that will report as an installment loan that will help boost your credit up. Or you have the trade lines that are generated based on utility bills or access from somebody's checking account via Experian.
Got it.
Right? Then you have credit repair. Credit repair could be, for example, you have a client who got denied for a mortgage, right? Because they have a repossession on their credit profile. They have the car, they have the title, and they have the payoff letter. Why do they have a repossession on their credit profile?
Got it. It was reported improperly or something.
So we're finding inconsistencies, inaccuracies, or things that cannot be verified as them belonging to the client. Or, for example, an old collection account that truly is an old collection account is now being reported as a brand new collection account. What happens then? If you have a brand new collection account reporting on someone's credit profile, that's going to bring their score down drastically, right? You have situations where someone's car payment was being reported as $5,000 a month, when in reality it's only $500 a month. You're gonna have an issue with calculation and debt to income ratios when it comes to things like that. We have clients who were reported as deceased on their credit profile. We call them zombie clients, right? They're alive, but they're dead on their credit reports. And the problem with that is that a score doesn't get generated if they're reported as deceased. It'll say NA in that area where a score normally populates.
How does that happen?
Reporting codes. Someone just pushes the wrong button.
Oh, wow.
Yeah. Or another example, a mortgage gets sold to a different servicer, and the client is sending automatic payments to the old servicer, and now the new servicer is putting late marks on the consumer's credit report, and now they're going to have a problem with refinancing.
Jesus, that sounds terrible.
So what do you say about? So I'm going to tell you a story that I tell clients, and you tell me, correct me if I'm wrong. So
how long have you been telling this story?
For people who, all right, so can you see this little finger, this pinky finger, whatever it's called? So it got jammed up playing basketball, went 90 degrees this way. I had a guy pop it back in. Being as tough as I am, I didn't go to the doctors.
Right.
I could close and make a fist. All right, I'm good. I can do everything I need to do.
Sure.
Right. So the analogy that I always give everyone is that a collection that someone would have on there, if it's 3 years old, 5 years old, it's the equivalent to this finger right here, me going to the doctor, having it rebroken, reset so it looks nice and pretty. It's going to look prettier in the long run, but I'm going to feel pain and I'm going to have problems typing and doing everything I need to do in the very short run. Is that analogy a good analogy with the concept of paying off bad debt, collections, charge-offs, things like that?
It depends, right?
You're supposed to say yes, Gabe.
Sure, yes.
Always agree with a host.
Sure. So when it comes to collection accounts, you know, you always want to look at the date of first delinquency. That really dictates the severity of the account.
Like if it's 6.5 years, you may as well just ride the 6 months and get it taken off.
Well, how
Yes.
so, no, that's a good question. Why are you saying 6 months?
6 years, I said.
6
No,
years.
but it was 6.5 years. You might as
Because
well
it's
write
7
up.
years.
What happens in 7 years?
It just falls right off like it never happened.
Is that correct?
No.
Well, that's where I'm getting. I want it out in the open.
typically-
Because
It does, but it doesn't.
I'm trying. I want
It
assumptions to be cleared at the end.
It should fall off, right? So this is under the Fair Credit Reporting Act, which is a consumer protection law enacted in 1970 that protects the client, that states that all the information on your credit profile needs to be accurate, verifiable, and timely. Right? There's different things on your credit report that have different expiration dates, right? Not everything is going to be 7 years. Bankruptcies are different from, your closed positive accounts, which should fall off after 10 years, and your inquiries should fall off after 24 months, right? So there's variations all the way across all those different things, right? So in theory, they should fall off your credit profile after 7 years. Sometimes they don't fall off.
That's
another reason why credit repair is
like that big
important,
toenail
because
goes, doesn't
we can
fall
go
off.
there and say, hey, like this is so old, right? Sometimes we can even request for certain old items to be removed ahead of time.
Yes.
Right? So that's another option that you may have. Now, when we're talking about injuring yourself, right? The analogy that I like to use when it comes to describing collection
Let's record
accounts
this.
is like, if I step on your foot today, it's going to hurt, right? In a day, not as much. In a week, not as much. In a year, probably forgot about it. And after a while, you just never feel that pain. The older a collection account gets, the less of a negative impact they'll have on your score, right? Same with charge-offs, same with bankruptcies. They all have an impact right
Time
away.
heals all
Right.
wounds.
Even if you go
Thank God.
over the limit on a credit card, and you
sure,
allow
Sarah's
that
done
thing
that.
to report, it's gonna hurt.
Shopping Sarah.
Shopping
McGee. No, I'm sure we've all done that. At some point.
It's gonna hurt, but consumers don't think that it's gonna have any type of negative impact. Sometimes consumers think that more is better. For example, we had a client who consistently let a $100 balance report on a $200 credit card. That's
Terrible.
50% utilization.
Yeah.
It's horrible.
That utilization's terrible.
Should be like at $6
Yeah.
$6 is over
fill up
time.
the
Max
gas
is like
tank once a
3%.
month.
So like just like little things like that is what we try to educate our client on. So credit repair is not just like getting things removed off someone's credit profile because they shouldn't be there any longer. It's also educating them on how to properly use their credit,
How to have good
show
credit
credit
health.
worthiness, credit health, and things of that nature, and just teach them things that they don't normally teach in school.
What's your credit repair program like? Are you still charging based on what you remove? Or are you doing a monthly? How does
It's a mix. We give the client the option of both. We show them what it would cost doing it one way and what it would cost doing the other way. We give the client the option to select, which one's going to be the best for them.
So non-business wise, obviously, I don't know which is better for you from owning a credit repair, a credit company in general. From my standpoint, one of the reasons that I always refer you and your team is because I like to be able to say they're not, because a lot of the credit repair industry has a bad reputation.
Yeah.
Okay. And it has a bad reputation because what happens is that oftentimes these are individuals that, listen, There's some good people who have bad things happen to them. They have a bad streak of bad luck, and they're trying to find their way back.
Right.
There's other people who just don't give a damn and don't pay their bills on time.
Yes.
Right. And so there's a whole bunch in between. So one of the issues I've had with referring individuals to credit repair is all right, so we get over the stigma of what credit repair is, and we say, what I love about Gabe and his team is that they'll only charge you, obviously you have some sort of initiation fee or whatever it is, and then you charge based on your proof of things that you do, which I thought was awesome. The problem that I have, and this is where I get like, it's not against you guys, it's the consumer. The problem I have is that 9 out of 10 people I'll ask, would you like me to, I don't just make it a random introduction. I ask permission. Would you like me to introduce you to my credit guy, Gabe, and his team? And they say yes. And 9 out of 10 don't respond to your team. It's gotten to the point where I am jaded about people with bad credit, that they really don't want to help themselves.
I think it's two things. They may not want to help
that
themselves.
Might be the Republican in me, but I'm just telling you that's how I feel.
I also think that there is a embarrassment and a stigma to having...
I've already seen your credit. I know your financials. I know everything about you. And if the doctor, right, Dr. Mortgage in this case, did you see the award I got today, by the way?
I didn't.
Oh, I'll show you a nice little plaque.
Who gave you an award?
It's the 2025 Q2 Dr. Mortgage of the Year Award. Oh, God.
From what organization?
Brian sent it. He gave Jared the 2025 Beard of the Year Award. It was just a cute little thing. You would have seen it if you got here earlier than you do. But so we have...
Busy shopping at Macy's.
Busy shopping at Macy's. Love it. Good for you. Where were we?
We're not even open that early.
Huh?
I was here at 8:30.
That's a joke. So where were we? What was I just saying?
No, I was saying, people in general don't like talking about finances, especially the majority of people that don't have a very comfortable financial situation, which is probably most people. And credit is a very humbling thing because you're not just talking about what you did last month, but you're bringing up years of what you've done financially. And a lot of people have had hard times or weren't so responsible or whatever it is their case was. So they talk to you and you're like, your credit's not exactly where it needs to be for the mortgage that you want. Talk to my person and they can kind of help you through it. And the first things that they're probably thinking of is another person's going to have to see all of my stuff. They're going to have to go through all of this stuff. I'm going to have to explain all of the reasons why we have what we're doing. And then there's probably going to be more money involved and more time involved. And that's when I would bet a lot of people go, you know what? Buying a house right now is just not for me. I'll wait a couple years until things look different.
Fine with all that. Here's what my response would be. It's not just about buying a house.
It's about everything, of course.
You're going to need your credit for the rest of your life. I can walk into a bank, get any kind of loan at any point in time, right? And it's you earn that right. Whether or not our credit system in the U.S. is correct, whether it's the system we should use, it's the rules that we have in front of us. So I'm not saying that, it shouldn't be that way. Listen, one of the, like here, you know what I love? Your business debt. So I want to talk about business credit.
Sure.
You have expertise in that area as well?
Sure. Yes,
perfect. So like
He's Dr. Credit.
Huh?
He's Dr. Credit.
I get it, Dr.
Sure.
Aw,
I'm
Nurse
sure
Sarah.
so. Dr. Credit. I won the Dr. Credit Award.
I did go to nursing school.
Yeah, see?
When I started working in the
hospital. It wasn't a dig. It was an actual.
I cried too much. So
I think, I've done this for over 15 years now. I mean, I've counseled.
You look a lot younger than Emmanuel. You guys are almost the same age in your careers.
I'll be 43 this year.
I knew you were younger.
How old are you?
How old am I? Yeah. You'd be surprised. I'm going to be 47 in a couple months.
You're not much older than I am.
46.
Yeah. All good. Yeah. So
Sarah and I are just a day apart.
Oh, okay. That's cool.
And a handful of years. But here we go.
Yeah. And I mean, we've known each other for, I don't even know how
long time.
It's been a while, a really long time.
I'm sure. I've been doing this for 20 years.
Yeah. And what I've noticed, is that some people, they are very embarrassed, so, one thing that I've taught my team and my staff is like be there as a friend for these people.
Empathy.
Like listen to what they have to say, because like they've gone through a lot, so a lot of times we're like a psychologist or a friend that's there to listen to them, but at the same time helping them with their credit all at the same time, right? Now to your response, where certain people don't want to communicate back with us, or they don't pick up the phone or anything like that.
Why not?
A lot of them
why not even have a conversation, Gabe?
But
Listen,
a lot of them are
500 credit score. My score's really bad. I'm embarrassed to say it, but today's the day, right? I weigh 350 pounds.
I was just going to say
today's the day. I need to get my fat ass off the ground.
And then those
I need to get in
people
shape.
go,
Now,
it's going to start Monday.
Not every-
It's going to start Monday.
You don't have to be 150 pounds to go from 350.
Not everybody, but not everybody's like
330.
that.
Just improve a little bit.
Not everybody's like that. I mean, we have spoken to your clients before, right? We have, right? Some of them, like I had my business partner Adrian. He's like, he was telling me a story about like Sylvia, who was reaching out to one of our clients, and the client like literally picked up the phone and was like, I don't know if I can curse on this.
You can curse.
Sure.
Oh, he was like, fuck you, like don't call me anymore. And Sylvia was like, oh, we're here to do your file review. You're our client. Da, 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 da. Fuck you, don't talk to me anymore. He thought it was one of the collection agencies that just called him seconds before Sylvia called, right? So it's like it's years of
psychological
hiding
credit,
and like
shame.
And there's studies out there. I have a colleague that has a nonprofit that did a study on the effects of suicide on people, or the effects of credit and a correlation with suicide. And it really does have an effect on you mentally, to like have all this debt, to have like all this pressure and all this responsibility. So from a psychological standpoint, we understand. We do our best to try to reach out to them, and if they want the help, they'll take it. If they don't.
What percentage of individuals 18 plus have a credit below 600?
I don't know that stat specifically.
If you had to guess.
What percentage? Below what?
Below 600.
You think it's 20%?
I think it's
maybe
higher.
I think
40?
the percentage for people with a 579 and lower to go delinquent was 67% of them actually going delinquent. I don't know I can look up the stats. I can try to find the stats, but probably what you said.
Now, what I will say at the same token is that mortgages, the average FICO of mortgages has risen every year. It's getting better and better.
Yeah.
The risk on the loans that we're writing are getting easier and easier from that perspective. There's getting to be probably very much like income disparity. There's also a big credit disparity in our country. And the what we see significantly more is higher credit scores.
Correct. So you actually have seen an increase in credit scores from 2007 to currently now. So the lowest credit score was right after 2008, average credit score.
Makes
for
sense.
obvious
People
reasons.
were dropping all their houses.
Right. And then one of my theories why scores are going up is because all the negative stuff that happened during that time eventually fell off or didn't hurt as much. And then with technology and like apps and like access to your personal credit score, people have been more conscientious about it and have been directed towards, getting better at their credit and all that stuff, right? Average credit score in Florida, do you know what it is for 2024?
In Florida, we have a lot of people. What do we have? What do we have? How many million people do we have here? 15 million people in this state? Does that sound right?
Probably.
My guess is probably 640, 660.
No.
It's higher, 710.
707. It went up 1 point from 2023.
Got it.
Right. National, I believe it's 717.
Oof.
That's all according to Experian.
Got
right?
it.
So scores are going up, and a lot of people don't even know that they qualify for a mortgage.
Right.
You know?
Business debt.
Okay.
All right. So one of the things that we see a lot of small entrepreneurs, something that they need to listen to this podcast and do, is they need to start acquiring business credit
Yes.
through their EIN,
Correct.
as opposed to just their social security number, doing it as an individual.
Sure.
So as an example, when we spend money on my company, on the credit card, that Amex bill, you don't see it anywhere on my credit report.
Correct.
It doesn't show up anywhere. Therefore, that debt doesn't get counted against me when I'm trying to buy a home or anything because it doesn't show up. So talk business credit. How does one build business credit? Because it's not easy to, all right, so like you can get your business Amex, fine. So we get a business Amex and you build it up a little bit through that. What other ways other than an Amex can you do?
All right. So one thing that you have to, like you were saying, yes, it's, and this is something that I always advise realtors to do, right? Because a lot of them have LLCs, but they're all using their personal credit cards for expenses. And I'm like, why would you be doing that where you can actually get a credit card with probably an even bigger limit? And it doesn't even report on your credit profile. You know, you build your business credit high enough, you can eventually get cars through your EIN number if you wanted to as well. Okay. The reason I have so many credit cards is because I have a lot of LLCs and I have a lot of different business credit cards, right?
I found somebody to take you shopping.
Yeah. Right. So, okay. So there's,
Just kidding.
there's different bureaus that, that register your score, right? Like the most basic business credit score is between 1 and 100. But you have your Paydex score, right? You have your Intel score with Experian, you have your Equifax Business, and then you have your SPSS score. Your SPSS score is for an SBA loan, if you ever wanted to get an SBA loan. The three that I mentioned prior to the SPSS score, those are all mainly on your business credit. SPSS will look at both your personal credit and also your business credit as well. For anybody,
Do you have access? Like, so my credit company that we use, so that pulls all of our credit reports for all of our consumers, they don't pull business credit reports. Do you have ability to pull my business credit?
Yeah,
report?
I can send you a link. You can take a look at what what they're reporting, whether you need to build.
Perfect. And so you can, because I want to get my business credit report up. I want to make sure we have 100 score, all of that.
Sure. Yeah.
All right. Cool.
So like a lot of so you have to think about
things I learned today.
A lot of business owners, you know, when I talk to people and I say, well, I do credit repair, and they're like, oh, well, my credit score's fine. I'm like, yeah? What's your Intel score?
Yeah.
They're like, what the hell is that? I'm like, you're a business owner and you don't know what your Intel score is? They're like, what about your Paydex score?
You don't?
You know?
I just told you I don't.
So like that's another thing. Like credit repair is not just about fixing what's broken. It's what's building what's not there.
Intelligence.
Right.
I would change the word repair. I would ask ChatGPT. I'm sure Sarah can help you there. It's her go-to. But no, there's got to be
for me.
Wait. Oh, that's your shopping assistant.
Yeah.
No, but they have
That's kind of cool.
I think if you added another word, or if you transformed a word that could mean both repair and build.
Liberty Credit Experts.
No, I get that part. But all right, we got to wrap up. But I want you to talk about your networking beast.
Okay.
And some of the stuff that you're doing with that, what you're trying to do. Networking is Sarah's forte. It's your forte. This is when I shut up.
Sure. So back in the day, I used to go to like a lot of networking events, and you know, either I didn't like how people treated me, didn't give me the time of day. You know, I didn't like the crowd that I was around. And I went to all these events because I was growing my business. You know, when you quit your job and you're like, I'm going to start my own business, I never looked back, and I've never had to work for anybody else, which was like awesome, right? And I came home and I sat on the couch and I'm like, I network a lot. I'm such a fucking networking beast. I should just create my own. And then I created the Networking Beast.
Networking Beast.
I threw my first event, and then I learned the power of data, the power of automation, the power of marketing, the power of networking, the power of creating community, which is really, really important. And we've thrown over 315 events now. We've had over 10,000 people. I've had events from Miami up to Tampa. I have an event literally after this podcast. Right.
I got your email.
Down outbound. Everybody gets my emails, right? Everybody gets my emails. And it's just been a really cool way to connect with people. It's gotten to the point where like I'm collaborating with like FAMP now, you know, and helping different associations. And now we're helping raise money for nonprofits as well. And it's just really nice to create an environment where everybody's like happy and welcoming and just being able to do business with one another, you know. So I feel very fortunate to have created that business, and I kind of look forward to just keep going at it. Tomorrow I'm going to Orlando. I have an event in Orlando. We have them in Tampa and Fort Myers and Cape Coral.
What's your favorite kind of event to throw? Because your events are different.
Yeah.
P. Diddy event.
P. Diddy events. Yeah.
The non-white party.
Yeah, baby oil. No. My favorite events. I don't know. I think that I personally like teaching. I like educating.
Yeah.
You know, like the events are great. You know, I'm at the check-in table because I get to meet everybody.
Right.
You know, I'm not out there like with everybody else, like drinking and having fun and connecting. Like I'm there like at the check-in table. There's a purpose for my event.
I think that's actually almost more purposeful because you're having that one-on-one time before they go in. They know to look for you.
Yeah.
They're connecting with you, and then whatever else happens. But like you were their first touch point.
I meet everybody that comes into that room. You know, whether it's 50 people, whether it's 250 people.
Right.
You know, the most people I've ever had an event was 350 people at Buddha Sky Lounge, which probably was like crazy. But my favorite events, I like doing like education. I like teaching. I like getting in front of people. I like teaching them what they haven't learned
Giving
in
them
school.
some value.
You know, and I've taught like over 5,000 realtors already.
That's awesome.
So it is awesome. You should collaborate with that database.
Yeah.
All right. If somebody wants to get a hold of you for credit building, credit repair,
credit
networking
health,
beast, credit education, credit
business
classes,
credit,
business
whatever.
credit, all of the above, how can they get a hold of you? We're also going to put it in the show notes.
Sure. You can call 561-208-1105, or you can email me at gabe@libertycreditexperts.com. If you're a realtor listening to this and you want us to do a CE class at your office, or you want to come in at Choice Mortgage and do something here with us,
we'd love
to do it.
We should do that.
We could host it here.
We should host everybody here. Sarah can little goodie bags. You can teach your stuff, and you can see classes.
I'll put it on the business Amex and build your
I'll
business
stay in my
credit.
office. I'll
There
stay
you
in
go.
my hole. Awesome, Gabe. Thanks so much for being a guest.
Thank you.
Thanks, Gabe.
everybody.
Okay, that's enough whining for one day. We are so happy that you could join us today on Stop Whining About Real Estate. So please, not only listen, but subscribe, follow us, download, share, and if you're feeling it, give us a 5-star review. Hey, and if you'd like to be a guest on the show, please email stopwhining@choicemortgage.com. Thanks so much.